What's up, friends? Back for the afternoon session. See what we got going on here. Welcome to the stream. Afternoon lessons like we do. We start doing this every afternoon. So I can get organized with like the new layout here. All right. What's up? What's up? What's up? Give him that bear zone dip on positive DD. I'm gonna take that. I usually don't trade at night in the afternoons, but like so. But I'm gonna start doing it just to have fun. Just why not? Why not? We can have fun, right? Have a little bit more fun in the afternoons with you guys. Kind of keep it exciting. Let's try to grow this time slot and take over. We know how this goes. I'm looking for a hedge pressure tap from here. A little bit. See if it works. Let's grab 2 contracts. Nothing big. Nothing crazy. Yes. Thank you. All right. Let's see if we can. Let's do some math here. Yesterday in the afternoon session, we had like 10 people, maybe 15. We never did this time, so now I got 30. We got 200% gain. That's all. I'm all about that. I'm all about being a winner. Thanks for tuning in. Let's take a look. I made some cash this morning. Oh shit, my trade taken off already. This is all I want to do is trade in the liquidity pocket back to bull zone. I'll take another 500 bucks. Let's call it. Scalping the hedge pressures. Boom. All right. So that's 1190 today. Let's call it. Nope, sorry, 1090. I can't do math. Here I am talking about how great I am at math. 1090. Hey Matt, what's up? If we open in the bull zone, if we end up in the bull zone 79% of the time, did I get that right? When DD, yeah. Under all conditions, when DD ratio is greater than half, we expect that number to go higher. If we don't know what it would be, we expect it to go higher. If you guys mind, give me some love. On the stream, give me some love by clicking the like button. This is my trade right here. I longed right here. I exited at the middle. That's a simple scalp. It's likely to go all the way, but because we had it here, I exited early. Exited has 1 E, not 2. Make sense? This is my trade today right here. This is a quickie 500. We back. What up, Louis? Can you add color to SPY PA today? Res was positive. We opened in bull zone. We lost hedge pressure, regain it, and lost again. Let's take a look. So throughout the day, right? Talking about those like conditions where we talked about this morning is going to be flat and choppy, just kind of a day to sit out. As resilience was fighting to go negative, positive, negative, it was still trying to hold. But then as you're hitting this bull zone, right? This is the long I always try to take. I always try to long a bull zone bottom. With a stop right here, 1 strike distance away. So the long entry here, at this point where my mouse is, you can see resilience was already at 0 pretty much. And it started to fall through. There's always a 1 strike stop that I take. So my stop loss would have been right here. But because my stop loss is at my second entry point, I would have longed and then cost averaged in and then held at least to middle. So this is a winning trade, even if it does break hedge pressure, because the max, again, this is how this works. Let me make this big, show you guys how I do this. If it's your first time here, please subscribe to the stream. We'd love to have you. Okay, we'll show you the way that I do this, right? So this was my long trade from here to here as a quickie. Super easy. Setup. Let's do 2 of our rules together, okay? Number 1, this, when you have hedge pressure equals bull zone, bottom, equals monthly hedge pressure with DD greater than 0.5 is our strongest support that we have. This is strongest support when they all line up. So far, so good. And today we had all the pieces but 3. We didn't have MHP at the same spot, but this is the strongest support. Under all conditions, so forgetting DD, forgetting everything, under all conditions, 75% chance here, 25% chance here. So under all conditions, I expect the market to stay up here. Under all conditions, right? With DD ratio being good and all that, allow me to have an even higher probability of that likely happening. Okay. So a couple rules with the DD ratio. Number 1 is I always long here. Number 2, if bull, okay, if bull, I always long here. If mean reversion, I always long here at minimum. Does this make sense so far? Why is Google? So on the bull zone, I always buy bull zone bottom. In mean reversion, the DD rule, I always trade to the middle, DD greater than half as well. They both apply. So this is a long and this is a long. So I usually take both. I missed this because I was busy, but normally I would long here and then gently wait and long again. Normally, if I long and then cost average in the second, I only cost average in at least a maximum 1 time ever. I never do more than 1 for the most part. If I dive back in, I long heavier. So if I would have bought 1 here, I would have bought 2 more here for a total of 3. And anytime I dive back, I dive into a position that's heavier, when it retraces to the next stopping point or the next resistance period, I no longer risk it. I either trim out the heavier position here or I close the whole thing out. So this trick has saved my ass so many different times. That big 75-day win streak that I had a million years ago. I remember that. I streamed every single day, and for 75 straight days, I was on a win streak. I cataloged every day. And they're like, trolls are coming in masses trying to watch me fuck it up. Okay. And a strong bull market, mind you. So because I long here with my, okay, so forgetting the bear zone is here. If I long here, my stop loss is one point away, or 10 points in ES. 1 point away. Maximum stop loss. So my stop is in here somewhere. With rule 1, longing a bear zone, but bull zone. But rule 2 is I'll always long here. So therefore I could combine the two trades together because they're so close. I need to take both of them. Anytime I long at a support and I long again at a stronger support, more often than not, in the middle, I'm at least closing out 2, which isn't those 2. It's if I buy 1 and buy 2 more and I go here, I close out 2. So it's really closing out this one and closing out this one. And now I have my original position of 1 with a cost basis here. So I took this cost basis and lowered it to here. Made a little bit of money along the way. Does that make sense? So that's typically the way I do it. So if there are 2 really close trades by each other, I take one, I take the other. Why did it break? You had just, I mean, Nasdaq's at 0, resilience is at 0, closer to 0 here. The market can just break on news or volatility or end of the day mechanics. Just normal, right? As you get close to here, the market is random after 1 p.m. As this rule comes on, market does random shit. So I like to wait for random things to happen to kind of line up my 2 trades. Now, hard stops or mental stops, which one do you use? Hard stops are good. I use mental stops because I don't like putting something on my chart to like reveal or to manage. I know where I'm going to get out. So if I'm going to long here and I'm going to take a second entry here slightly heavier, boom and boom, then my real stop is going to be under here. Now, I don't hold 10 points in the S&P down in the bear zone. I typically give it about half a point, give or take. Like I make sure that it's really good because my new R&R on a dip is always to retrace to here. So my profit target is to there, then my risk is to there as well. So if it's only half a point of move, then I'm only about half a point of stop. I never stop further than the profit I want to take. So 1 point is the maximum stop loss. So the maximum I ever do is 1 strike distance. That rule is the max on this trade. Now I extended it a little longer to allow myself to get a trade to here. As my second entry is here, I only plan on going halfway, even though I can hold for the risk of going all the way. Since I can only go halfway, half a point, then I'm at maximum. I'm going to stop half a point lower on all of it. On all 3. So 1, 2, stop on all 3, close out of 2, close out of the other 1. So buy 1, buy 2, close out 2, close out 1, or hold the 1 to go. So right now, if I had made the trade here, which I missed, I wasn't here, I would have bought 2 here, which I did, by the way. I did, and closed out in the middle just like I normally do. Here's the 2 and then minus the 2. That trade I make all the time, and that was this. I literally, when I got on the stream, the trade was active, right? Close it out. Oh, you can't see all of that down there. Let me move this up a little bit. There we go. That's a little bit better. So a couple rules, right? Bull zone is always super strong. And sometimes you can break it. It doesn't, it's, remember, it's 25% chance we see it end up not there. But as a rule of thumb, anytime I take a second entry, I'm not like, if I long somewhere and then I long again a little heavier, I'm not betting on, if this is my first entry and I'm diving in, I'm not betting on this. I never dive in to bet on a break. At minimum, I'm trying to get back to where we started and say, oops, that's like the small percent chance it went against me. Oh, thank God I got lucky. Let's test my second place as resistance. Let me get out of here. If I buy and buy heavier, when you do the return trade and you're not being greedy and you exit for where your first entry was, more often than not, you're going to realize you did better by walking away. So anytime I have to add to a trade because there's 2 entry points close to each other, I pretty much exit at my first entry point as a rule of thumb. I don't ever try to go for this big break here. Okay, give me 1 second. All right. You guys, any questions for me? What's the latest timeline on the marketplace? This weekend. This weekend, we're migrating all of your accounts to marketplace accounts. So you should be able to wake up one day next week and rocketscooter.com will go directly to the new marketplace account. You'll be able to log in there, access your platform from there, launch your platform from there, buy and manage your data feeds from there. And then once we start unlocking the other services like the trading platforms, coding language and all that, that's not launching. That's coming out like in a month. It's ready to go. But launching is getting the platform, a couple of our white labels on there, Discord communities, courses are coming out like this next week. So basically the courses, the Discord, the platform, the data feeds, all available on Marketplace with all of our affiliates there, all our affiliate links there, all our vendors there ready to launch. And then within a month, Rocket Script will probably come out for the server side, and then like less than a month later for the client side. So you can have local Rocket Script here to write your own indicators locally, or you can go get the server enterprise where you can code on the server and sell it or host it or share it. We have taken any short setups today. I did. My first setup was short, and very rarely do I do that in a greater bull market. But I'm trying to be a little more exciting on the stream. I've been finding out that while I do perform better than pretty much everybody on YouTube, people don't understand. The kids out there today don't understand that performance comes from patience. All of you rational adults here do. And understand that waiting for a setup and going is the perfect way to trade. It's just not the perfect TV show to watch. So while statistically is not the best setups out there, I'm still going to start taking them and just trading small, knowing that, okay, I'm not in the best possible setup, but let me do something anyways to kind of keep folks happy. As I'm finding out the, just from the feedback, some people are like, I just watched the stream. Do you even trade? I'm like, I'm actually trading right now. I'm making 1,000 decisions by not trading today. And so usually if I think in a bull market, normally it's going to fall. I just get out of the way and let it fall. These days, I'm going to try to take some short scalps during the fall and then get my bull set up after that. So I did take one today, not my normal trade. You take. But in this particular setup right here, this is exactly the scalping setup I took. It was on NASDAQ. Let me show you very quickly. And again, I typically will only short against the greater market. If the greater market is bullish, which I'll again repeat how you calculate greater market, I will only short scalp typically through redistribution zone. It was very simple. The trade I took today that was worth the 500 whatever bucks was literally just that. This was such an easy setup. Nasdaq's at the top of the box. Resilience is negative. It's fighting negative. Some big stocks are jumping around. It was negative. I shorted it back to the bottom of the box. Everybody see that? That's it. The cheat sheet on resilience, which is available in your Discord. Everybody, who here? Type yes if you understand. If you know where the cheat sheets are, say no if you don't. Did you know we had cheat sheets in the Discord and on the website? We'll bring up the resilience really quick. Res bearish. Bring this guy up. You guys got it? Cool. All right. Yep. You guys know where it's okay. So top of the box, resilience negative just pushes to the bottom of the box. It's just a scalp. And in a greater bull market, I'm not trying to bet on reversals. I'm just taking the trades that I know. So it happened a couple of times, right? Anytime res is not, you have very strong bull market. So here we do greater market, right? Every morning you're going to do this. It takes about 30 seconds to do greater market. Okay. You do monthly maps. You do MHP on SPY only. SPY is the force that drives all the carts. You do DD ratio. So right out the door, the two quickest and easiest ones. The SPY MHP is like way down here. So that's bullish. DD greater than half, that's bullish. Look at that. 2 out of 3 done in record time. Monthly map. Quickly. You have to decide bull zone. Does anyone have trouble reading monthly maps? I can go through that really quick. Monthly map on the cheat sheet, super easy. You're looking at 3 things. Is the bull side sloping down or up at the bottom? Is the bear side sloping down or up at the top? And is the market getting more volatile or more liquid as time goes by? Pulling apart, it's volatility increasing, pinching together, liquidity increasing. Okay. So as you see, each one of these is looking into the future. This is June, July, August, September, and we got monthly map showing the future all the way through October, and it's still showing a general bullish trend for the long haul. So the bull side is sloping down. It's kind of choppy, but it's doing it. If you were to just draw these bottoms of the bull zones, it's choppy over like the first like maybe 8 or 9 days, and then we go into just those straight weeklies in here. So from like here to there, it's sloping down. It's a little bit, but it's sloping down. Bulls are longing more. We're in accumulation phase. Okay. Bulls are buying the dip, buying the dip, buying the dip, buying the dip. So every dip is going to get bought up. Likely so until the conditions change. The market is structured this way. Monthly map is literally the strongest tool you have for seeing the future of the market, because these are people's positions in the future. It's revealing the future to you through options. These people are holding these positions. There's no analysis going on here. This is just revealing what is. Okay. The bear side kind of flat and choppy here for like 7 or 8 days, and then bear side also sloping down. So bears are exiting. So not only are longs going heavier, shorts are getting out. Twofold squeeze. Okay. So in general, when we say that that's happening, we draw 2 little up arrows. Bulls can't wait to long the position more. Bears can't wait to get out of the way and close their shorts. 2 groups of longing, or 2 groups of buying in a market that's not that volatile, which is the middle. As you see on the S&P, you do all the analysis. I'm in QQQ right now. S&P likely looks the same. QQQ, there is no volatility. Pinching together, right? Or tight. There is no space between the zones. I mean, not that volatile. Looking at SPY, you're supposed to do this on SPY, by the way, as you get Qs. Let's correctly look at SPY. SPY, bull zone, while choppy, and it's got some liquidating periods. Still sloping down in general with a few profit-taking weeks. And bear side, still in general, sloping way down as well. So while there is some kind of interesting mechanics in here, like some selling off leading into monthly expiration in June, after June, the visibility is still bullish as long as Fed doesn't do anything crazy, whatever. So bear side sloping down, but we do have some potential selling pressure towards the end of the month in June, end of the trading month. So like third week. That being said, I wake up every day and say, what's the analysis? I go, okay, bear squeezing, bulls longing. In 2 weeks, maybe some selling pressure. Not that volatile, so dips will get bought up. Check. So up, 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 up. Greater market is bullish. Okay, so I take that greater market and that aligns me with my trade I want to do every day. So the greater market is bullish. I wake up and I look for the bull setups. Okay, what are my bull setups today? And how do I structure a bull trade? And if I do take a bear trade in the middle, nothing wrong with that. But my brain knows that dips are going to get bought up, and dips are getting bought up. Dips are getting bought. This market's not having an easy time crashing now, is it? The greater market will tell you that. There's no catalyst today. There's no event today. There's no reason for market to be selling off today, is there? Not really. So every dip has a higher probability of getting scooped up because the longer term positioning is bullish. Bears can't wait to get out of the way. Bears get a bunch of red candles today. They're going to get out of the way as fast as they can. Bulls can't wait to buy, and they're buying the dip. Y'all see that? So the monthly map is just painting the picture of the overall market over time. Over time, between now and October, bulls and bears are clearly showing a buying spree. Commitment of traders, which is the other thing we look at, enhances that greater market understanding if you want to do COT really quick. A similar format, but this is using futures instead of options. Rule of thumb, the commitment of traders. This is showing futures positions in the S&P as well. Anytime you have the green lines, the asset manager side, I'll show you this in the... I teach really good lessons, but have y'all seen the video Commitment of Traders? One of the best things you can learn. This bottom chart is all you need in the FTR report. Asset managers is green, hedge funds is blue, dealers are red. Rule number 1. Pinching or pulling, the market is liquid. When there's buyers and sellers or sellers and buyers finding each other, right? Longs getting more long, shorts getting more short, then every buyer is finding a seller. Liquid market. Liquid market does not crash, like pretty much ever. Green line and blue line, liquid market, yes or no? Quick, quick, quick. Type in chat, let's see what you got. Yeah, Google, when you lose HP, that's really what that volume spike comes from. It's gamma squeezing. So like the market, gamma is the highest acceleration of delta, which basically means the highest order flow for hedging. So delta is the change in price of the option versus the underlying. And so if the option changes in price rapidly, the amount of shares you need to buy for change in price is the highest. So the highest rate of change of delta is the highest order flow in the underlying. So when you break hedge pressure, just a teeny little bit, you see massive amounts of volume shifting because that's the maximum amount of order flow. So that's why you see volume spikes at hedge pressure, because at maximum gamma is maximum change in delta. And delta hedging is buying because of change in delta. So if the change in delta is maximized in maximum gamma, then the order flow is maximized. Does that make sense, Google? If you don't, it's hard to wrap your head around that sometimes. I know it's like a hard concept. Gamma is equal to first derivative of delta. You guys are like, holy shit, fucking differential equations. They're dells because these are partial derivatives. Black-Scholes. Long story short. Change the price, the underlying option, change the price, the underlying. So when the option changes price relative to the underlying, that ratio is delta. The faster delta changes, i.e. curvature, acceleration, the curvature is captured in delta. So the acceleration of the price of the option, basically. So long story short, when you're delta hedging, every single increment that the price moves, for every increment that delta moves is an equivalent of number of shares you must buy to neutralize. So the change in delta equals the number of shares you buy. So the maximum change in delta, so gamma max is the maximum change. Maximum change in delta equals the maximum number of shares bought, which is why there's a volume spike. I try to make differential equations as simple as possible, but does that make sense? The easiest way to think about it is when people say gamma or gamma exposure, gamma, all these kids out there talking about gamma these days. Gamma just means maximum order flow because everyone's delta hedging, and that's basically what it shows. So when you break hedge pressure, you always going to see a volume spike. It's longing and shorting. It's just a flurry. Maybe longs are flipping short. Maybe shorts that were empty are finally going short. Maybe longs that were long are finally going to zero. It's just max amount of activity. It's the sum of everyone's hedging strategy creates a flurry of effect. You have a little parabolic. I didn't think I was such a mathlete, did you? I sound goofy on the stream. I'm talking about yoga, gardening, EDM concerts and stuff. But yeah, I didn't know I was also a semi-accomplished mathematician. I tend to get serious at times, but I try not to make it too heavy because math is just hard for a lot of people to like think of, especially on a YouTube stream where nobody wants to after eating lunch. It's kind of a heavy subject. Do I hold futures position in the next session? Cliff Kelly, never do I do that. And never should you do that either. The futures day ends at 5 Eastern or Central. And the very next moment that the market opens is a whole different day. The CME group runs a procedure called the IOP at 6 p.m. that basically forgets everything that happened at 5 p.m. So the market trades, Globex trades from session to session. Here, the futures is never a continuation of the previous day. Never, never, never. Futures is designed to track the stock market. That's the only tie it has to the previous day. The stock market might still be trending. But every day, the IOP is an algorithm that the CME runs that looks at like the aggregation of all orders pre-market in the pre-open state, like before the market can open. In the dead zone, you can still place orders on the bid and ask. And they look at all the dealer bid and ask positions and then do a calculation. And from all of this, it equals the opening price. So wherever they open the next moment in time is an equation that picks that price, actually. It has nothing to do with the previous day. So when they run that model, there's a video on the CME site that tells you how they do it. They're just looking at the distribution of everybody's limit orders before the market opens. And that dictates the opening price. And that's particularly random as our evening is actually the morning in Australia and the morning in Asia and the morning in Europe, like rotating in that order. So it's like a whole new day for the rest of the world. It might just be an hour change for us, but this is a defining period that at 6 p.m. for us, the futures world actually says that's the morning of next day for everyone else. So while it's just an hour passes for us, the rest of the world that was been sleeping here is finally starting to wake up and start their new day. They've had a whole day to sleep. Inside of here, they've had all kind of news happening in Australia, news happening in Asia, news happening in Europe. and they're finally going to wake up and start trading it. So these two are not connected at all. So there's really no reason to hold a position through the session. And number two, for margining purposes, if you're trading on intraday day trading margin, you're going to be expected to hold the maintenance margin of that position holding into close. So if it costs like 10K to hold that contract, and your broker has you trading at like $300 margin and the rest of it's margin, but the maintenance or the actually in futures for the overnight, they make you hold the initial because it's considered, it's different than a maintenance in the FINRA world. So if the initial is 10K, which is the bigger one, typically they'll make you hold the initial going through the overnight as well. A lot of brokers do that. I think actually all brokers do that. So holding through here, if you only put in $300, if you only have like 5K in your account and you bought a contract for $300 and you hold through here, your broker is going to be giving you phone calls like right here saying, hey, you need to close your position. Hey, you need to close your position. Hey, you need to close your position. And if you hold it through here, you're going to get a margin call from them because you need at least the minimum. You need at least the minimum to hold that position overnight. So if you do want to trade overnight, just close out and reopen. They're not connected at all, and the open price is going to be pretty random. Gap up, gap down. You'll never be able to control or see what that is, and your technical analysis will never pick that up. Because if you watch the video on the CME site, they tell you exactly how that equation works. We can watch it real quick. It's actually kind of cool. For all things futures, you guys come here. You can learn whatever you want. I'll teach it.
Welcome. This video provides times and trigger additional relation to all other orders
this is
to
kind of
determine
fun.
the IOP. Order quantities are aggregated. Quantity order is a price level with
This is how the opening price of futures is actually determined.
largest matchable quantity.
I'll skip to the fun part.
As each order is accepted, its price and quantity is assessed in relation to all other orders to determine the IOP. Order quantities are aggregated at each price level.
This is the bid on left, ask on the right. And this is pre-market, so the market's not open and trading.
Limit order quantity.
Just FYI, the reason there's no like bid up to here and ask up to there, like, you know, a normal ladder is going to have trades here and trades here, right? There's going to be a gap between the bid and ask. But in the pre-market, there's no market price. So the bid and ask is all across the board. They overlap like this. So what they do is they're looking at the overlap. They're taking the cumulative quantity, like on the bid side, counting down. So if this is the actual orders, 5, 20, 40, 50, 10, 5 at these prices, and these are the sell orders, 10, 5, 20, whatever. On the bid side, they count down. So they take 5, and 5 plus 20 goes here, and then 25 plus 40 goes here. So they're aggregating the sum of all of it. Does that make sense? So all the orders here, they're adding up the sum. Now on the ask side, they start at infinity low, or sorry, 0. So the ask at the bid price, they start at infinity and count down. The ask price, they start at 0 and count up. And then they aggregate this way, 5, 25, 75, and it adds up. And then where they overlap is expected to be the highest liquid spot, basically, of all traders. So the overlap is where they're equal to each other, 190, 95, 100, where they crisscross. The two graphs crisscross. Then they open right here. Y'all didn't know that. That's how that works. So that opening price in futures is calculated that way.
Price level for the bid and ask. A cross book is an order book showing orders that would.
I'll save you 10 minutes of video, but that's how they do it. Like, and then that's 95 is the matchable quantity, blah, blah, blah. So, and then they talk about like tiebreakers and other things in here. But the CME group is really cool at explaining like all the Globex stuff. Yeah, so that's why like I never trade overnight, just or hold through the session, just because it's a whole new day and they're going to run that calculation and calculate it anyways, and it's not related to the previous day. Okay, cool. All right. So there's that bull setup, back to bull zone. If I were long all the way through here, this is the perfect exit spot for a long. If I were long still and we're back in bull zone, the 75% chance, I'm done. I'm out. Let's see how that works. Okay. That's it. That's a gimme setup right there. So I closed early, but that's it. I would not trade any further than here if I was trading this right now. Anybody take any scalps today? in the afternoon session. Hey, you guys run all things, all futures related questions. I mean, you can ask whatever you want. Okay, so here, bull side, bear side, they're fanning apart, which is a liquid market. Buyers are buying more, sellers are selling more. So buyers and sellers are finding each other. So liquid markets do not crash ever. Illiquid markets sell off for sure. So when they're both sloping down, like here, market sells off. Look how beautiful that is. I've trained like so many of my friends out there that are like trading educators. I've trained them on this very thing. And they say this like overnight has changed their understanding of markets and trading. This one lesson of seeing positional shift is what inspired me making all that I made in Rocket Scooter. Like, here's a good strong bull market. You have them fanning out. You have them fanning out. You have them pinching together. So anytime they're pointing away or pulling together, it's a bull market. And look at that strong bull market, right? The moment that they're both pointing down, does everyone see here? They're both sloping down from here to here. Look how beautiful that is in the positions, right? The market is sloping down. Bulls are exiting. Bears are now shorting harder. Everyone's selling. And therefore, your market started selling as your bear market. And all the way up, they're fanning apart, pinching together, fanning apart. This was slightly pinching together. This is pulling apart. This is pinching together. This is pulling apart. So from like here to here, it's been bullish. There's never been a time when they've been sloping to the downside, right? And from here to here, it's been an upward trajectory. It's the easiest thing in the world to learn. Liquid markets do not crash. Illiquid markets crash all the fucking time. Illiquid markets is when they're pointing in the same direction. Everyone's selling. Longs are selling, shorts are shorting. Anytime they're both pointing up, is usually you'll get a short squeeze very rapidly. It's illiquid, so it's a very rapid paced move. So liquid markets do not crash. Illiquid markets are taking time like a crash. So in the history of the stock market and futures market, one more thing to take away is that never in the history of the futures market, one time has this ever happened, is that anytime the dealers, this red line is positive, the red line here. Dealers, if you write this down, learn something today. Dealer's position, net position, positive. The market has never crashed. Once. In the history of this report, which is like 25 years old. In the history of this report, when this red line is above 0, the market never crashes until it's above 0. The dealers do not crash the market, and they themselves are long. It's above 0, sorry. So market's selling off here to here. This dealer position goes positive right there. So in October of 2022, when I famously posted, I said bottom is in. Hey, have you seen my tweet? Who here hasn't seen my tweet calling the bottom literally right there? I don't call bottoms and tops often. Literally 2 days after it bottomed out, I said, this is it. This is the bottom forever. We're never gonna fall below this in my lifetime. Oh, let me show you. I use monthly maps and committed traders. Call the bottom. Get bigger market swings can be predictable to a degree by looking at the positional shift. I have a lot of lovely things bookmarked, my friends. Okay. Okay. Let me. All right. This is another tab. Wait. I wish I can like open this in a different tab. Make this bigger. All right. So I put pictures of the tweets with it. October 17th, 2022. Literally this day of this green candle right here. I use the understanding that the market is selling really hard, and the dealer position is positive. And so here, right? As the market fell to here and the dealer position is positive, it's not going to crash. So when it was supposed to rally here and sold off again, everybody in Rockseer camp was like, oh my God, the bottom's in. Dealers do not crash the market. This was not another wave down. This was the inflection point to go up. When the market hit previous lows, with the dealer now accumulating the net long, dealers don't drop the market when they're long the market. So this one tweet of mine just took all of my big calls and put them on the chart. So here is where I actually called the bear market. So for as long as I can remember, I'm seeing a positive short-term correction. And I never say that ever. Like this whole time, I never said this after COVID. In February 2021, bull market's going to double in the next 3 or 4 years. From S&P 3,800. So I was saying 6,400 we're going, and people thought it was crazy. And now we're trading 5,400. We're almost there. So in February 2021, I used monthly maps to know that we're still bearish. We're still bullish. And the Fed started doing like their rate hike game, inflation, and then that pivoted the market lower. But even down here, exactly at this spot, I called a 2-month bear market rally. I looked just at monthly maps for 2 months. It was bullish. So bear market rally for 2 months was exactly 2 months long, actually. Right here, I said, well, we called the July 2-month bottom and I longed and then shorted at the top. I did short at the top there. I'm now calling a bottom for 2022 and a rally through mid-January, genuine buying. And it's been rallying ever since. The bear market gets nasty again Q2 and summer for lower lows, if so. And then when Q2 came around, here's June and July, I changed my thesis and said, nope, the recession's over. And then monthly maps, as you see, it might be really small for you to see, but bull side sloping down, bear side sloping down. And I was like, oh, breaking news. Monthly map changed and the bull sentiment changed from Q2 to now October. And then it's been going on ever since. I can't remember what made me short here. I think like inside of here I shorted, I don't remember. I had to go back and search my tweets. It could have been monthly maps or it could have been breaking monthly hedge pressure or something. But we knew that as the dealer position was positive through here, that right about here that the market was going to stabilize. And you see how monthly maps, they're both sloping down. It's kind of small on my chart, but you can see this. They're both sloping down. So even here, as it's double topping, we're like, yep, this rally could last for 4 more months, volatility and absolute decay. This is in October through October of 2023. And then that kept rallying and that came around. We said it's still bullish. And now we're saying it's still bullish through October of this year. So monthly maps is just bullish, 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 bullish. And so utilizing that and the commitment of traders, I think here, which is that point we were talking about. Oh, this is why, because the bulls started selling again. Once the bulls inflection point were selling and the dealers were selling, we were like, okay, you know, right here, just these like this couple like right here. I think I shorted like on this one. I was saying, okay, it's probably going to double bottom. But when we hit that double bottom, we're turning around right there. The bulls stepped back in these 2 weeks. You can see that the bulls are stepping up while the dealers are positive. And never in the history of this report with positive dealers has market crashed once. And you take that as your best piece of trading advice you've ever had. Anytime this red line is above 0, the market it resists a crash. Anytime, even though there's a little bit of selling, the market resisted a crash. The momentum was up. Here, when it's positive again, as it retraced half the distance, the momentum was up. Anytime this red line is above 0, the momentum is up. Every single time. So it's like the dealers are long the market. They're holding the bag. They never crash their own market because they're the ones with the risk. They're going to raise the price to attract buyers, shorts, squeeze the shorts out before they crash the market. And here it was positive in this little leg up in the double top. And then finally, when it goes negative, then we had the recession. How cool is that? Even the recession could be seen. Check and zoom in. That same mentality. The others are positive. So the market dove really quick, and then the dealers are positive for 2 more weeks as we rallied to highs. And then once dealers were negative, and then it started collapsing on itself as you had bulls starting to sell. So like right here, you wouldn't have seen a market crash coming. It just looked like a decent normal dip. So like if I were to actually draw, this is a fun little lesson. Leading up to here, you have bulls longing, bear shorting, markets liquid, dealers negative. This retrace up to this point looked bullish. It looked like it was going to do this, but the talk was bad. Housing market's going to collapse, and some bad news data started coming out. And from here to here, you had no activity. This was flat while they were selling off. So from like here to here, you had a big wave of selling pressure right to here. Market kind of hung tight, and then right here, it crashed out like it consolidated, and just this bombardment of selling pressure off of that bad news. Just it was trying to hold, and then it just tipped the scales. And as soon as it crashed, all those shorts covered and took profit. All the people that shorted the collapse, and then boom, they took profit here. Market stabilized once the dealers are buying the bottom, Fed injection of money, and the long step back in, market bottomed out. So it's neat to see how this works. Like it looked really good until the long started selling. And that's kind of what you're going to look for periods like waves down, is for like the longs to be selling, creates that volatility in the waves, the legs down to the downside. And so right here, as we see we're trading at highs, let's do some analysis here. Are the longs doing anything from here until here? Is this line selling off? Is it up? Is it down? Is it flat? What do you think? They're holding the fort, right? It's flat. There's longs are not selling, so this is not coming down. For the last maybe month, shorts are covering, longs are holding flat. So we're propagating like a kind of more like a bulls are holding the fort and bears are starting to cover. And then in monthly maps, looking at the options, look at this. Bulls are not doing much the next couple weeks. Very neat. The bull side is sort of flat positionally on Qs. So this kind of reflects what's going on in the options world, which is neat. Reflects kind of what you see in the futures world. The bull side is it's sloping down a little bit, but it's relatively flat. You're not getting a lot of momentum. But the bear side is sloping down faster. It's kind of easy to see that the bear side is like deteriorating faster. The bull side is like not as aggressive. Bull side's like this, bear side's like that. So it means like there's not a lot of change in the bulls. The green, they're opposite. So if these are pointing down, what this means is if you convert monthly map to committed traders, bull side is slightly sloping up, bear side should be sloping up faster. And in futures, you're seeing that reflection here. bull side is less aggressive than bear side. So you can even see that reflected in the options. It's neat to see it. So commitment traders, options, they all kind of circle back on each other. Flat dealers are negative. Yeah, so the dealers are typically almost always negative the market because there's always more people buying the stock market than shorting the stock market. So the dealers typically maintain a short position and are buying calls to hedge that, which is forcing the call sellers to long the market, which raises the bid and the market goes up. Easy as that. And the longer it's bullish, the more people buy, et cetera, et cetera. Yep. A little lesson there. Commitment trader is very important. So greater bull market can be enhanced by your understanding of the commitment traders, just to look for any evidence in futures. Clearly, nobody's selling this market, right? There's no sellers, and bulls are strong, nice and strong. Easy does it. So any short setups I do take when the market is so like unbelievably bullish, you know, is I usually will only short inside of the redistribution zone. Like resilience is negative, I'll take a scalp through there. Anybody take that long here? Took the bear zone bottom close early, but green is green. There you go, Chad. Let's go, baby. Thanks for the info, Matt. You learned so much from Rockstar. Oh, thanks, man. We kind of threw technical analysis out the door and we're trading with just positional analysis. Positional risk analysis is the style that we invented, is what we call it. Looking at positions and people's positions into the future are easily seen in options if people are showing you their hand. And try to work on that as much as possible. Do I convert the redistribution zone? Chris Newport says in SPY to ES prices. I do, but normally I don't convert it directly. I just stare at it. So I will, when SPY hits a level, I will just click the sell button or click the buy button. I just throw a market order in there at the same time. So if this gets here, it's hard to convert on the fly because they're not going to be exact conversions. The S&P and the equities and the futures are necessarily like moving up at a ratio of 1-to-1. They typically stray from each other slightly. So like to say like, okay, what is 534 SPY equal to in futures? If you were to do that conversion like here and do that conversion here, you would actually come up with two different numbers. As the S&P and the futures are like, you know, they look similar, but they don't trade exactly on each other. So the small discrepancies cause that ratio to be off. So if you were to do a conversion at any point, like here, okay, let me convert what it should be. When you get there, it's never that number. It's always slightly different. So what I do is I just, when this hits the level I want, then I just come in and say, oh, S&P is going to pivot. Get the long. They're all the futures trade independently, so they're going to, you know, they all try to track each other, but they're off slightly. You do like a real-time ratio of the two. You see that like the S&P divided by SPY is never exactly 10. It's like it ticks every update. It's like 10.01, 10.04, 9.97, 9.92, 10.08, 10.1. It's just like, okay. They kind of deviate plus or minus a percent, give or take. Less than a percent, but it's enough to make your numbers slightly off. But they definitely skew from each other a little bit. Question. So it makes sense. Did Rockstar have any package? So got you for clarifying. You only fight the overall market in the redistribution box, pretty much. Like the market trying to fill the gap because stocks are selling and filling their gap is the trade I'll take against the bull market. I don't ever bet that the bull market's going to collapse underneath all this bull evidence that we have. That makes sense. Hey guys, don't forget, subscribe to the stream if you can. We're trying to build out this time slot. I'm going to start doing some afternoon trades if I can after lunch and doing educational topics free. Don't forget to check out the Rocket Scooter platform while you can. The website has a 1-month extended trial. Check it out. It's only $35 for the whole platform and all the indicators come with it. Move all your accounts to the marketplace this weekend, so you'll have a whole new experience going forward. Platform will be accessible there. Brand new website, brand new everything. So you should wake up, your same login, email, and password should work over at the new site. We're going to move all of your emails and passwords and create your account for you over there and move your membership over there for you. Nothing should change. So normally scalping in a bear market and bull market against the flow is always because of resilience. That's the only thing that tells me to go against it. If hedge pressure breaks and markets dump like today very rapidly, I still stick to greater bull market. If there wasn't an event that caused this to happen, there's like no news coming out, I don't trust it. So if the market just dumps because of some random selling, I'm smart enough to know that 75% of the time or more, it's going to close back up above in the bull zone. You open in bull zone, you'll close in bull zone. Under all conditions, 75% chance or higher. When DD is greater than half, the probability goes up. We know it's got to go up. While these lights are green, it also goes up. So under the worst conditions, still majority of the time, I go back in there. Now, if there's an event or a catalyst, a news event happens that caused this, like CPI fell down here, I'm very less likely to trade it back up into there. This is just the normal ebb and flow of the market without external factors. The hedging and positional landscape brings it back to bull zone. External factors, though, can change sentiment. Anything that changes sentiment, I don't fight with. I consider random and I get out of the way. Yeah. So today was a pretty decent setup. I did one short, one long. That's it. All right. You guys have any questions for me? That's pretty much it. Lessons, questions. Yeah, only go against the herd on the redistribution zone. I'm still waiting for bigger bull setups. But if you see it on my screen, like that's enough for a decent profit. For not a lot of like risk, not a lot of activity, not a lot of you know, just waiting and being patient, really not a lot of trades actually, just in very clean, easy setup. And I waited, I took it, I got in, got out quick. Moderate position. I think it's 2, nothing crazy. My 2 trades today, I know it might not seem like a lot. Very predictable there with negative resilience. And from here to here. That's all I did today. That's all I did. And they both won. But it's like, you know, it's choppy, you know, it's kind of blah. Then you just take whatever, you know, does make sense. There was no reason for me not to hold to there. But I play it safe. I usually close out more than half and then hold the rest, but I just closed it all out. Watching hedge pressure zone on the ES to SPY. Should you watch SPY? Okay. Another thing. So the hedge pressure is calculated with SPY options. It's like internal to the world of SPY. The futures numbers that we show you here, the dynamic hedge pressures and futures are actually any of the futures numbers here are located in the, or like tied to the futures world. So they also act as pivots in their own way. So in here, you can see that sometimes they line up, sometimes they don't. There's pivoting action between our futures pivots as well. Different rules for those, but at the end of the day, they're just like to take note of. Well, the reason I closed out here was because we hit another pivot, and I just use these as exit targets usually. So usually my entry points come from all of this. These are entry points. Exit points are usually here for the most part. DD bands, illiquidity pivots, overnight dynamics. They tend to create those as exit points. And half the reason I talked about today that while we were going to be choppy and flat was because the market, like right out the door, was trying to fight its way into here. You just have like a bunch of pivots all pile on top of each other. So the market is like playing ping pong against them, right? It fell into this like trap, basically. Illiquidity pivots, which is why the moves were sudden and sharp. So futures has its own mechanics, reality, but I don't long or short typically off of these. I use them for confirmation. So like today, if people were longing to hear when I said if this is long is a great time to get out, there's really nothing in the equities world that tells me that. But futures world, there's a pivot right there. That's why I said that. So I'm always glad. That's why I always have both on the screen, because both are important. There's a little bit of hidden evidence there where I circled on the right, like that yellow line. It's called an illiquidity pivot, margin buffer limit. There's a whole video on how to calculate that. Or you can just steal my number and use it. It's going to stay there for a while. And yeah, so the long trade goes back into bull zone. But how far into the bull zone? Well, there's not a lot of evidence. You can basically exit the trade there at the redistribution zone, or yellow line, similar spot, and get out. That's how I do it, Chris. What's the difference between watching the hedge pressure zone and ES to SPY? Yeah, you should be watching SPY to pivot hedge pressure. And then where it goes to, you can use these pivots here. So like when this took a nose dove and hit bear zone here and bumped up above monthly hedge pressure estimate in futures, you have the futures pivot, the equities pivot were slightly off, but they both work. So when they're both supporting, it's really strong. So even like right here, that spot is when they were both supporting. That was supporting, bear zone was supporting, and they line up. So when they line up, there's usually a little bit more support there. Double reason for it to be solid. So yeah. All right, love you guys. I'm out. Thank you, chat. Don't forget, subscribe while you can. If you haven't been here, we're here every morning, every afternoon now. We tripled this time slot viewer base. Let's get it to 100 by the end of next week. Tell all your friends, bring them all over. Free lessons. We love you. Help us spread the word. Help spread the word in the marketplace. You know, people come over. Good day. Good day. Have a good one. Love y'all. See y'all later.